Liquidity risk means there are basically whenever you don't have money to pay your EMIs, that's called as liquidity risk. Same thing applies to banking also. Okay, so let's start. Okay, firstly, before going ahead, has everyone registered? Type yes in the comment section. Has everyone registered for CAIIB? Type yes. If not everyone, I'll just see. Type yes. If not, you still have time. Okay, along with the charges, some 100 200 charges. First week 100 means second week 100, third week 200. Okay, so you have some time now, but do register it immediately. Don't wait for the last moment. Okay, so do it first. Okay, let's start. Yesterday I had given you one homework. Which of the following forex transactions have been used in treasury management operations? So treasury uses which one mainly? Is it arbitrage or is it swaps or is it both A and B? So what is arbitrage basically? Says arbitrage means buying from one market and selling into another, like this. Suppose let's say NSE. We have two stock markets, NSE and BSE, right? So what do we do over here? I'll buy a Reliance share, Reliance. Okay, let's say it is at 2000 over here, and here it is, let's say 2005. Okay, 5 rupees difference on these two stock exchanges. This remains hardly for 5 seconds, not more than 5 seconds. So I have to do everything between these 5 seconds only. What will I do? I'll press buy over here and press sell over here immediately. So I'll be, how much will I gain? 5 rupees. So you'll say, why should I do everything for 5 rupees? No, buy 1 lakh shares, sell 1 lakh shares. How much have you gained? 5 lakh. In how much time? 2 seconds, 3 seconds, not more than that. Okay, so that is the point. That is the beauty of arbitrage. First thing, arbitrage main point is time. Okay, now what is swap then? Swaps means, after all, it's here, one leg is fixed, other leg is this moving, okay, or fluctuating. Suppose if I take 1 lakh rupees from you, okay, and I guarantee you, let's say 7% rate of interest, 7% guaranteed. Okay, I've taken it from you, this money is taken by me, okay, at 7% fixed rate. So what will happen? I will have to give you 7%, right? So what will I do with this 1 lakh now? Suppose if I invest this 1 lakh in stock market, okay, imagine I can do various things, but today let's say imagine we invest in stock market. So this stock market can give me roughly in an year either 50% return, means if my stock goes up then, or minus 20% return, it can go down, isn't it? Or 0%, anything. So what do you mean by this? This leg is fixed and this leg is fluctuating. So that is the point over here, fluctuate. Okay, so understood this? Arbitrage means what and swap means what. So importantly understand, banks use and treasury, basically treasury uses both A and B. Okay, now what is liquidity risk? It is the inability to obtain funds at a reasonable rates for meeting cash flow obligations. So reasonable rates, that is important. Meeting cash flow obligations, that is important. Means what? Suppose if I have to pay some loan, right? So I need to pay some EMI. If I don't have money, what will I do? I'll get that money from somebody. Now if I get that money at a higher rate of interest, then it's a riskier part for me. So getting at a reasonable rates, that's important. Okay, getting at a reasonable rates is important. Point is that. Okay, now coming back. So how does this apply to the banking system then? It applies to the banking system at reasonable rates. Means suppose if the bank, how does the bank get funds? Banks get funds from deposits. So if they give you higher rate of interest for deposits, bank will lose. So what is the theory or what is the logic of banking? The rate of interest for deposit rates should be as low as possible, right? Deposit rate should be as low as possible, and loan rate should be, what does the bank try always? Loan rate should be as high as possible. Only then will they get the amount, right? What do you know about, what do you mean by this difference of this, right? The difference is known as NIM, net interest margin, right? So bank will try to get the maximum out of it, isn't it? So liquidity risk are of two types. There are two different types of liquidity risk. The first is known as funding liquidity, cash flow or cash flow risk, while the second is known as market liquidity risk, also referred to as asset product risk. Means what? Funding liquidity means getting the funds on time at reasonable rate, that is funding. Market liquidity means due to the market situation like COVID. What happened in COVID? Many of the loans were becoming NPAs. Why? Because the situation was such. People were not able to repay their loans. While the second is known as market liquidity risk. Correct? This one. Before going ahead, download Adda 24/7 app, everyone. In this app, you will be getting the premium study material plus live classes, ebooks, tests, everything. Okay? So download it right now. Okay? Because this is very important. See, our exam is just now, what, 2 months from now, isn't it? CAIIB. Not even 2 months now. Okay? So see this slide. In this slide, basically you will see the everything about liquidity risk. I'll expand this. Okay. See this. Liquidity risk is the risk that pertains to conversion of assets, securities or bonds into cash without affecting their market price due to unfavorable economic conditions. Means if I am able to sell my bonds without affecting the market price. How many of you know the failure of that SVB bank? SVB bank, right? Remember this? Just now failed. SVB, Silicon Valley Bank. SVB bank. Why did it fail? Because of this reason. The bond rates of that bank went down so much, okay, that it couldn't sustain. Okay. What was that Adani's attack? This Hindenburg attack on Adani. What was it? Nothing happened later. Okay. Adani is still there. Okay. But what was that? That was again on bonds. The bond prices were to be brought down. Okay. So that is basically liquidity risk. Everyone targets in institutions, they target their bond prices. That's basically liquidity. So types of liquidity risk: funding liquidity and market liquidity. Already I told you. Relevant ratios. Which are the ratios to be considered for this liquidity risk? The ratios are current ratio, quick ratio and interest coverage ratio. Okay. So what is this liquidity gap between, means why does this liquidity risk arise? Because gap between demand and supply. Means if I require the money urgently and there is no supply of money, so then I'll be facing the liquidity risk. Types of assets which I am holding. Types of asset means, suppose if I am holding 2 houses, prime property, 2 houses in main city location, 1 crore each, but I don't have means anything to eat, means to run my current daily expenses, then what's the use of those houses, right? Those are the long term assets. So these things happen with many of the banks also. They have all the long term assets, but short term they can't run. Why? Because their assets are not managed properly. Cash flow constraints mean the required cash flow doesn't come in. This is basically because of this COVID-like situation. Cash flow means people didn't used to repay the loans at that time, right? How to manage it? Effective cash flow forecast, investment management, keeping the track of liquid assets and managing the and reducing leverage, right? Uncertainty with regards to interest rate at which future cash flows could be reinvested. Now means, what do you mean by this? The meaning over here is, what do you mean by uncertainty with regards to interest rate at which the future cash flows can be reinvested? So when we have uncertainty, that is called as which risk? Reinvestment, interest rate risk, gap risk, or none of the above. So it is called as what? Uncertainty. Means what? Suppose if today I am having an FD of, let's say, 8%. So will I get the same FD for 8% after the maturity? Will I be able to invest it? So that's the point. So that is known as which risk? What does it mean? Reinvesting. So reinvesting means it will be reinvestment risk. Got it? When a bank borrower or a counterparty fails to meet its payment obligations regarding the terms agreed with the banks, it is called as, means basically counterparty risk. Okay, means bank gives the loan, right? Loan to customer. Okay, but the customer is not repaying it, does not repay back, no repayment. So that is called as what type of risk? Market risk, operational risk, liquidity risk, and credit risk. So what do you call it? Is it market or operational or liquidity or credit? It is. First I need to explain you what is this. See, the answer is credit risk. But for that you need to first understand what are the types of credit risk. Credit risk are of two types. Always remember. Country risk means, and second is, okay, let me write it first. Counterparty. Okay. These are the two types of risks in credit risk. How can these happen? See this. Country risk means what? Your customer is good, but the country in which that customer is, that country is bad. For example, if your customer is good in North Korea, he is a good customer, he was regular repayment, doing repayment, but the government doesn't allow it. Or in Afghanistan, the government over there is Taliban government, it doesn't allow. So in that case what happens? Okay, so that is country risk. Counterparty means what? The country is good, but the customer itself is bad. For example, like in your country, good countries means what? Any country, we can just name them. Okay, USA, UK, anyone. Okay, Germany, India. Okay, country is good, but your counterparty is not good. So in that case, again it becomes a credit risk. Now before going ahead, subscribe to Officers Adda 24/7 YouTube channel. Now tell me, you all guys are watching right now this YouTube series. Where are you watching? Just check the YouTube channel on which you are watching, everyone. It is Officers Adda 24/7 YouTube channel. So on Officers Adda 24/7 YouTube channel, you get it all this YouTube series on various subjects. So that's why they are very useful for you in exam. Number two, you get the latest updates regarding JIB, CAIIB and other banking exams. So that's why subscribe to it now. Whatever is available free, and is there any charge for this? No. So whatever is available free, you must grab it first, isn't it? So subscribe to this, click on the bell icon. Okay. When a bank chooses the wrong strategy or follows a long-term business strategy, which might lead to its failure, it is called as, means what? Wrong business strategy, which the bank shouldn't have chosen, but it chose that. So that is called as what? Credit risk, operational risk, market risk, strategic risk. Do you know any example of this? Wrong business strategy. Wrong business strategy. I have given many times the example of this Nokia, right? Nokia, and Nokia means what? Nokia was a leader in mobile phone. Now it is gone. Why? Because strategic risk. It didn't choose the strategy properly. It didn't check that the world was moving towards this Apple and this Android, right? So it should have ventured into those markets, but it didn't. BlackBerry. What happened to BlackBerry? It was one of the signs of BlackBerry phones some 15 years ago. BlackBerry phones were a prestige issue, right? Now it's gone. Where is BlackBerry? Is it existing? No, isn't it? Why to take these two examples? I'll give you many examples. SVB Bank. SVB Bank. What was that SVB Bank? Same strategic risk. It didn't think properly. What did it do? It took the money of small investors, means investors basically, and it invested in long-term bonds. 30 years bonds. long-term bonds. If you check the SVB bank's details, it has invested in 30 years bonds. Okay, and the money is of whom? So simply current and saving account of those what Silicon Valley companies, okay, startups. Do you think any company who is investing, keeping saving and current with you, that company will keep for 30 years? So how can you invest it for 30 years? That's basically again strategic risk, right? You don't follow your strategies properly. What is the strategy in banking? For Nokia it was phone. For banking it is what? Banking is, you have to think ahead, whatever is going on, right? So these things happen, okay? Uncertainty with regards to interest rate at which future cash flows could be reinvested. So future cash flows can be reinvested means what? If I have to get some future cash flows, in the sense, suppose if I am keeping some FD, let's say I am having a rich person, I am having 1 crore FD. So it is what? 8%, let's say 7%. 7% means 7 lakhs I am getting in the year. Per month I am getting what? Divided by 2, right? Roughly 60,000. So that 60,000 whichever comes to me monthly, I have to reinvest it somewhere. So where will I reinvest? So that is known as which type of risk? Reinvestment, interest rate, gap, or none of the above? What do you say? Type fast in the comment section. Let's write this ABCD, okay? A, B, C and D, okay? Let's write it like this. So what do you say? Is it ABCD, A or B? Correct, it is A, right? Reinvestment risk, isn't it simple? See here, whatever, suppose if I am getting 60,000 per month, okay, and my expenses are roughly, let's say, I am imagining, this is all hypothetical, my expenses are 30k per month, okay, so this remaining 30k, I'll have to invest it somewhere, right? So where will I invest that 30k? So I must get some higher returns more than this 7%, otherwise what's harm in keeping it in that FD again, isn't it? That's the way. Now one for your homework. The yield to maturity of a bond is same as, what do you mean by YTM? Okay. Have you studied this YTM any time earlier? I know you have studied it. Where? In bonds, accounts, okay? CAIIB. Even in CAIIB you might have studied them now. YTM means what? Yield to maturity. What do you mean by yield to maturity? Suppose if I purchase a bond today, and let's say the life of that bond is 3 years. Okay, today, and then 1 year, 2 year, 3 year, okay? So if I keep this bond with me for 3 years up to the maturity, what will happen? This bond will give me coupon for first year, coupon for second year, and in the third year it will give me what? Coupon plus principal, right? Coupon, principal, face value also, face value plus coupon, year only coupon, right? So what do I do? This coupon which I am getting, okay, each year, and last year I am getting this face value, this is known as redemption value. Complete thing is known as this F plus C, redemption value, okay? So this amount which I am getting, what will I'll do it, do the calculations and bring them to present value. Find the PV of all these, PV, okay, of all these coupons and this redemption value. So this PV which I am getting, okay, this I'll find it using the percentage. So that percentage which I get is known as YTM, yield to maturity. Means suppose if I hold any bond up to maturity, the effective yield, rate of return which I am getting effectively, that is known as my YTM. So the YTM of a bond is same as what? The present value of the bond, future value of the bond, bond's internal rate of return, and none of these. Now this is for your homework, okay? Remember, one thing I'll tell you about, explain you some few points about this. Present value of a bond means what? It is same, see this, whatever I am bringing it over here, if I bring the money over here and calculate it in terms of rupees, so that will be known as present value. If I calculate a percentage, effective percentage of this, then that will be called as YTM. And what is IRR? Future value is different. Future value is whatever I'll be getting at the end over here. Means I'll calculate all the values and means use the compounding effect over here and use the find the future value, okay? Internal rate of return is different. Bonds internal rate of return, if I explain you more, you'll get the answer only. Okay, so that's why check it yourself, do it yourself. Okay, now before moving, let me come to the batches. See this, the batches have recently started. Okay, the CIB batches. So go for the join the batches ASAP, because why, 2 months are remaining only, isn't it? See this, if you look at the batches, go on Adda 24/7. If you're having the app, I would suggest download the app, everyone, because in the app you're getting 1% extra. You have a coin system. Okay, click on JIB and CIB on the front page. You'll see CIB 23, JIB 23. Click on CIB 23. Okay, clicked. You'll see the batches. See this, revision batch, selection batches. Okay, click on the selection batch, English batch. Okay, so you'll see the details. What are the dates, timing, day, study plan, everything you'll get it over here. Study plan is very important. That will guide you how to study. Okay, so importantly, remember, recorded videos are available 24/7. So if you miss out on any class, you can definitely get back using the recorded videos. Okay, 2 interactive classes, you can ask the questions there and then itself. Okay, so that's a good point about it, isn't it? If your doubts are cleared immediately, it's a big deal. Okay, so Lord, let's talk about the fees. 5297 after discount, but click on more offers. Put the code Y432. Never forget this code Y432. Click on apply. Look at this. Now you are getting still more discount. 4799, 23999 reduces to 4799. Such a huge discount you are getting, isn't it? So you should definitely join the batches, because portion is new, subjects are new, and remember, exam is just 2 months away now. Okay, in fact, you can go for Mahapacks. In Mahapacks, what happens, you get 15 plus batches. See this, I'll show you that also. Go to JIB CIB again, click on JIB CIB Mahapack, click on this CAIIB ka Mahapack. Okay, now you're getting double validity. What do you mean by double validity? See this, 6 plus 6 months. Earlier you are getting only 6 months, now you're getting 6 plus 6. And what about the fees? Again, you see, importantly, more than fees, look at this, what are you getting? 15 plus batches per subject, you are getting this. Okay, mock tests are available. Then importantly, your electives are also available over here. Okay, see this, electives are available. That is the important point. Okay, in Mahapacks you get the electives. Okay, in regular batches you don't get it. So join the Mahapacks. Okay, more 7699. Now click on more offers. Put the code Y432. Look at this, 6999 means 7699 to 6999. It's still reducing. Okay, so 80% off. And if you are on the app, you are having the coins with you, you'll get 1% more. Okay, so 1% more is a great help for you. Okay, so I would suggest everyone should join the Mahapacks and the batches. Why? Because again, I am telling you, the exams, the subjects are totally new. I have been teaching this and the subjects are very tough. Okay, and it's not possible for anyone to complete the subjects within 2 months if you study it single-handedly. If you have a guide, a mentor like us, you'll definitely be able to clear it. Okay, so again, I'm telling you, join the batches, discounts are going on.